I'm here this morning with Gary Kirk, Portfolio Manager at 24 Asset Management. He runs the Dynamic Bond Fund with the team of fixed interest specialists at 24 Asset Management. Gary, a lot of our clients are concerned about interest rates and what that means for bonds. What is your view of when interest rates may go up, and is it as bad as for bond funds as people suggest?
Well, trying to predict central bank actions is always terribly difficult, and this time around it certainly is the same. Actually, I would have thought before sort of Bernanke's comments about sort of tapering of QE back in 2013, it would have been the Fed that would have raised rates first. But given their concerns about large swathes of the consumer economy over there in the US having not yet seen any resemblance of recovery, I think that now the UK is probably going to be the first of the major central banks to raise rates. I don't think that's going to be until probably the second quarter of 2015. I think consensus is for February.
It is, isn't it?
But I think that I personally believe it will be a little bit later. I wouldn't be surprised to see them do it immediately after the election. No surprise there is going to be some sort of political interference there. But when they do raise rates, I think it will be small incremental increases, 25 basis points, and I think that they'll be watching it like a hawk to see how it impacts the economy.
Yeah.
So therefore I don't think that there'll be that much more than one per quarter over the coming couple of years. So I think that the US will probably be a quarter or two behind the UK, and then the ECB sort of further behind even still. So trying to project forward is always very difficult, but by the end of 2016 I think that in the UK 2% base rates is probably going to be there or thereabouts.
So with a slowly rising interest rate cycle then, and certainly maybe nothing for the next 6 months or so, how will that affect bond funds, and what is it as a strategic bond fund manager that you can do to mitigate interest rate risk in your fund?
Yeah, I mean, obviously, interest rate rises are not are going to be detrimental to holders of government bonds. I mean, there is a direct correlation there. However, not all bonds are as sensitive, and there are certain elements of some bonds that are not sensitive at all. So, slow rise in interest rate environment generally will dictate that the economy is in a healthier position, and the GDP of a country is picking up. Generally, that's healthy for corporates in that particular scenario. So therefore the credit spread element of a bond is generally going to sort of be a benefit. It's going to benefit in that scenario. So as a portfolio manager, what you can do is you can mitigate rising interest rates by using certain products that will actually increase as rates go up, and therefore to mitigate your losses. And there I'm talking about things like interest rate swaps and futures just to manage the interest rate sensitivity of your portfolio, and focusing your alpha generation on the credit spread element. And I think that portfolio managers that actually use those tools will actually sort of see good healthy returns even during a period of rising interest rates.
Gary, thank you very much.
You're welcome. Thank you.